Frank Dixon established global system change in 2005 when he recognized that system change would become the dominant sustainability issue of the 21st century. Engaging the financial and corporate sectors is essential to achieving system change. And as he'll talk about, he does this through system change investing, SCI, and total corporate responsibility, TCR. He's written extensively on these topics, and I think a discussion on systems change is a great way to wrap up our panel today. So take it away, Frank.
Thank you very much, Junie. As Silvio said up front, I've really enjoyed hearing everyone talk about the different leading edge investing things that are going on. Let me just change something on my screen here. Okay. Today I'm going to talk about, as Cooney said, a process called system change investing that can accelerate and enhance all the leading edge approaches going on here and more broadly in the sustainability field. And in some ways, I think it shows what the future of impact investing might be, the greater focus on system change, and I'll explain why that is. Our society is facing many challenges with COVID, political instability here in the US and around the world. The sustainability movement has done, and responsible investing has done great work for more than 20 years. We'd be a lot worse off without it. But yet, in spite of that, many environmental and social problems are getting worse. So it shows that new approaches are needed. The current investing and sustainability approaches focus mostly on directly addressing problems like climate change or the other SDG problems. And they're also very focused on trying to change companies instead of the systems that control them. This is fantastic work. We should expand it tenfold. But we also need a complementary approach that looks at root causes. Climate change and the other SDG problems didn't just show up. We created them, and the primary way that we created them is through our flawed economic and political systems that basically force companies to create climate change. If they don't do that, they go out of business. Nobody intended this. It's a result of reductionism. So the suggestion is continue to do the current stuff we're doing and expand that greatly, but also look more at the root causes, the flawed systems. And that's what system change investing does. So just to explain how it works, for many years, I was the head of research for the largest ESG research company. And I saw many examples of companies making more money by acting responsibly, but this was always only true up to a point. I estimated that companies generally could mitigate about 20% of negative overall impacts profitably. Beyond that point, if they continued to mitigate, their costs would go up and they'd put themselves out of business long before reaching full impact mitigation. So it became clear that system change was at least 80% of the solution, but getting close to 0% of the attention in the investing area. And this was back in 2003. As an ESG modeler, I saw, we were effectively using SRI to engage corporations in sustainability. And I figured we could do the same, engage them in system change in the same way by rating companies on system change performance, showing how these issues were financially relevant, and developing funds on it. We could use the same mechanism to push companies in that direction. So I developed the first model for rating companies on system change performance in 2003, and was, it was ahead of its time at that point, although I think the time for it is now. And I did a bunch of other things then, advising Walmart and other companies, but I saw we needed more information about how do we actually change our systems. We've been working on it for many years, economic reform since the 1970s. It's done some good things, but it still hasn't turned our systems around. I think the reason for that is, as Einstein said, we need to think at a higher level, use a whole system approach, recognize that everything is connected. I spent many years writing about that. So just to frame that up, a whole system approach to system change, and I'm going to wind up how investing relates to this, but just to set the big picture, a whole system approach realizes that we need action in all areas, government, public, and corporate financial. Principles of system change overall are emulating nature. That's the main one. We heard earlier about the circular economy principles of producing no waste, equitable resource distribution, equally valuing current and future generations. These are all aspects of sustainable systems. For humanity to survive, we're going to have to do that. The model for how to survive on this planet is right there in nature. Another principle of sustainability is democracy, and probably the most important one for the corporate and financial sector is the rule of law. I mentioned earlier that our systems force companies to cause climate change and other problems. There are many specific flaws that do that, like limited liability, time value of money, externalities, focusing on economic growth instead of social well-being. But if you took all the system flaws and rolled them up into one overarching flaw, it would be the failure to hold companies fully responsible for negative impacts. This is what creates a situation in competitive markets where companies can't voluntarily mitigate and remain in business. So the solution overall is to hold them responsible. When that occurs, they make the most money by acting the most responsibly. So in terms of how to actually rate companies on system change performance, it's a lot more complex than ESG rating. ESG looks at companies' negative impacts and the efforts to mitigate that. To rate a company on system change, you have to understand what it is overall. And then once you know what system change looks like, you can identify the optimal corporate role in that, and aspects of that role become metrics in the rating model. So just to give you a sense of how a company might be rated on it, the first model, and the one I developed in 2003, Total Corporate Responsibility, had three metric categories: traditional ESG, mid-level system change, which was looking at efforts to change systems at the sector, stakeholder, or environmental social issue levels, and then high-level system change, which is looking at efforts to try and change overarching economic, political, and social systems. In terms of metrics, the types of things we might rate them on: the presence and quality of a system change strategy. How are they working with government? Are they asking to be held more responsible or less? Are they engaging in collaborative system change? Are they using media campaigns to raise awareness about system change? And are they supporting system change organizations? So in terms of the approach, there are many benefits to this. At Innovest, the company I was head of research for, in almost every sector, the sustainability leaders were outperforming laggards. Rating companies on system change performance also can add alpha for two main reasons. We're assessing systemic risks and opportunities that aren't assessed by traditional ESG and financial analysis. And also it's a good proxy for management quality and stock market performance. System change is probably the most complex challenge facing management. If they can do well on that, it's implied they'll do well in other parts of the business and thereby make more money. Um, so it can add alpha. It also could help asset managers to increase assets under management, because by focusing on root causes, it has the potential to provide very high sustainability benefits. And because of that, it could help them to attract new investment. So it's, if you were to look at all the options available to humanity for driving system change, you could make a case that this is the most powerful one, because the corporate and financial sectors in many ways are the most powerful segments of society. They're controlled by investing. So if we use investing to drive system change, it's a powerful lever. It's also powerful because system change is highly complex. Look at our current political system in the US, that's not going to be easy to change. But SCI doesn't try to do that directly. Instead, it incentivizes companies, investors to figure it out and do it. So it's a form of indirect system change. Basically, I think this is where the sustainability movement in general must go. We have to focus on root causes, or, what we're doing now is it would be like trying to put out a fire with one hand and throwing gas on it with the other. We've got to address both the symptoms and the root causes. I think this is where responsible investing is going. So I'm glad to answer any questions that people might have about the approach.
Thanks, Frank.
Thank you. Thank
That
you.
was very, very interesting. I guess as a first question, and feel free to take this in a different direction if you disagree. But from what you're saying, it looks like you would be a strong proponent of a carbon tax. Can you talk about how that fits into your system's view, And as an investor, how can we make money in that?
Yeah, it's a perfect idea. That would be an example of a mid-level system change, uh, focusing on that. So yes, and the way that the approach that I'm suggesting would work is that we would go out and look at what companies are doing around system change. So if they're an energy company, are they lobbying to have a carbon tax? If so, they get a higher rating. The suggestion would be, because they're smart enough to see that that holding them more responsible for carbon will make acting responsibly on that issue profitable. They're going to be doing lots of other things well. That would be the argument. So a carbon tax is just one of many thousands of systemic type changes that are needed. That's a form of externality at a sector level. There's externality issues overall. Almost everything in our society is underpriced because we're not. That's another principle of nature. It's implied full cost accounting. Many of the costs of producing products and services are not integrated in prices. So it creates the illusion that fossil fuels are cheap when they're actually really expensive, and renewable energy can look more expensive than it actually is. I think the overall solution, as I mentioned, is to hold companies responsible. How to figure that out is hugely complex, maybe the most complex challenge facing humanity. But if investors start asking companies what they're doing about system change, that'll get them engaged. When I was at Innovest, companies used to come to us and say, how can we get higher ratings? CalPERS and others, are looking at your ratings now. And we said, here's our list of metrics. Do this, you'll get a higher rating. So when CalPERS and others starts asking companies about system change, they're going to say, wow, this is important. How can we do system change? And again, we could show them the list of metrics. Advisors can help them implement system change strategies. As they look at their different issues, that can lead them to saying, okay, carbon tax is a big issue for us, but it's just one of thousands of systemic changes needed.
Gotcha. And you know, um, I'm just thinking here. So I guess tell me if I'm characterizing this wrong. So if you want companies to pay for their negative externalities, whether that's environmental or social issues, that's going to take a cut out of corporate profits down the road. Is it an economic trade-off that way, or it seems like what you're talking about is, let's identify the kind of smart, forward-looking companies, and not necessarily they're going to take a profit hit by pivoting on these things, but maybe they can find ways to realign their business model where they have less of a negative environmental impact.
Well, that I know there's not much time left, and that's such a big question. So I could narrow it down by saying, 20 years ago when we went to Wall Street and said, do ESG, you'll make more money. They thought, no, we'll make less money, but they learned they could make more. Now they're doing it. When we start talking to them about changing systems that are producing record profits, they're going to go, yeah, I don't think so. But these systems also, by forcing them to cause harm, have feedback loops that are hurting them to a growing degree. So these systems ultimately are the enemy of business investors, because right now companies are forced to profit by harming society. That's not sustainable. You can't profit by destroying the environmental and social systems that enable you to exist. So the pain, and usually this happens very quickly. So as the pain rises, they're going to see, and look at the World Economic Forum. They're talking about reforming capitalism. The mainstream is already talking about this. The one thing that isn't happening yet is, how do we use investing to drive it and engage it. I think one final thing I'll say: people in the future are going to look back to what we're doing now the way we look back on slavery, because we're allowing companies to profit by harming the environment and society, and then we go out and try and make the business case and ask them, can you please voluntarily stop harming society? With murder and other crimes, we hold people responsible. When we don't hold them responsible, we're asking them to do something that ultimately is impossible for them to do. When we tell them stop all your negative impacts, we're really telling them to die. So the solution is to hold them responsible, and we have to find a practical way to do that, engaging and helping the companies to see that they're much better off having a seat at the table figuring out how to change the systems in a way that protects them and their investors, rather than having the systems collapse, because they're not going to stay the same. They're highly destructive. And with the trauma we're seeing in the world right now is showing us that we're in the midst of change right now. Our systems are changing. So,
Well, great. Thank you very much, Frank. That was a very interesting talk.
thank
So I very much enjoyed that.
thank you.